Hi, everyone. This section, Adrian, I think your slides, right?
Got it?
Got it. Awesome. Right. Hi, everybody. Okay, for this section, we have, of course, Adrian Chu from CSOP Asset Management, and he will be presenting about, the insights into Asia for at least the second half of 2021. Adrian, the time is yours.
Thank you, Ethan. Just a brief introduction. CSOP Asset Management is set up both in Hong Kong and Singapore in 2008 and 2018. Respectively. We are fully licensed by the Hong Kong Securities and Fusion Securities and Future Commission. In Singapore, we are fully regulated by MAS. So our strong Chinese roots from onshore Chinese business humbly place us as one of the China experts within the region. Now, good afternoon to all. Thank you all for joining our session today. And we're here to share some of our insights, our CSOP insights into Asia for the second half of 2021 and beyond. Now, there are many key factors that we are looking at right now that's affecting both you as investors and us as well as a financial practitioner as well. The many key themes that we are actually focusing on. Many events has happened. So what's next? How do we navigate, the market going forward? And right now, here's our main views globally and also what's happening within China. We break it, what happens for the last couple of months and in fact days into four major themes. Talking about the recovery mode, both global and China. I'll probably say China has recovered, I would say. And one of the themes actually inflation pressure as the global economy recovers. Definitely we are facing some inflationary pressure right now. China right now is going through a different cycle in terms of the stages, in terms of the market recovery. And last but not least, the regulatory headwind right now we face as investors and we encounter recently for the last 2 weeks with the massive sell down for the Chinese markets right now. So right now, I hope by the end of this session, you have a better picture of the global markets and the China markets, and definitely be informed of some of the potential investment themes for the second half of 2021 and beyond. So recovery mode, right? The main countries entering we're going to talk about, recovery mode. Some of the main countries have entered the recovery mode thanks to historical height of government stimulus measures globally, within Singapore, especially US as well, 1.9 trillion aid package that probably will drive some form of inflationary pressure right now. The current average inflation under the average inflation target level, the Fed in summary, likely to show a higher tolerance to inflation. That's our view. May not shift from easing to tapering until both labor market and inflation data show substantial progress. So we expect, overseas liquidity to remain relatively sufficient, just to, but I must have to admit that right now, inflation is actually one of the risks in the recovery mode right now. China, in a different cycle, definitely recover much faster. First in, first out. But of course, they themselves first to recover. They are experiencing some form of imbalance, and we expect inflation within the country to remain modest. Exports remain resilient, and whatever the policies they have remain neutral, and even slightly towards the positive side within the Chinese economy. Regulatory headwind, for a high growth technological sector, we remain positive due to the long-term allocation values it offer. But we must have to admit that right now there's a bit of regulatory headwind, which is like right now the largest uncertainty within the short term right now. So these are actually four main views and some of the four summaries that we have. So let's dive deeper the global outlook. Thanks to the significant economic stimulus package, Singapore we have 100 billion, US with 1.9 trillion. The world is actually entering a recovery mode. COVID-19 still poses as the largest risk and definitely may last longer than expected versus the last SARS outbreak, right? We seen that major countries have actually made considerable progress in terms of vaccination. And vaccination targets actually been a key for many countries. And for the first half of 2021, we have actually made considerable progress in that sense. And we are looking, a gradual opening up and recovery from the lockdowns and from the COVID-19 so-called retracements that are actually caused by COVID-19. However, right now we are faced with a new variant, a Delta variant of COVID-19, and this could make the pandemic to last longer. WHO also did announce that there probably be a new form of COVID-19 happening, higher probability of that happening within this year. So COVID-19 still poses the largest risk right now for the global economic recovery. And we can see right now, like earlier in the webinar, UK, the United Kingdom has actually the highest number of people having at least one dose of COVID-19 vaccine right now. However, UK, we can see a spike in terms of new COVID-19 cases, and due to their Freedom Day, due to the attendance to the Euro 2020 as well. Now, what was on the optimistic side is actually these COVID-19 cases are facing milder symptoms, and they're not overloading their healthcare system. So again, that might be a new way of measuring in terms of new cases, but they're probably going to measure in terms of severity of these new cases. Around the region, Indonesia is facing a huge increase in terms of COVID-19. It probably be the next epidemic center within the region itself. India has definitely bring down the cases. The one in green has actually managed to curb the spike and actually bring down the cases substantially. Globally, right now we see again the numbers creeping back up. But however, on the safer, optimistic side, the cases are not very severe as previously we experienced last year. And having said that, we are going on to a economic recovery. And having said that, inflationary pressure is actually very prominent right now. It's actually within focus. As economies reopens, inflation expectations are driven much higher due to the fast rising prices of commodity for last year itself. Right, the inflation remain high when the demand recovery expands for second half of this year. That's our expectation, mainly driving from the US. And commodity prices have actually rolled over higher already. And as of what policymakers expect, we believe that would definitely be somewhat of some upward pressure on the inflation side for the next few months. However, we have a view that high inflation, the spike in inflation definitely is going to be transitory. It's only the small that of course we believe that the small inflation will definitely be there, will be here to stay. So having said that, we could look at the copper price, and the oil price has actually recovered, has actually gone up in terms of prices, and then definitely that serve as a proof that definitely there is a inflation pressure going forwards as the economy recover. And having said that, the rising manufacturing PMI show a very strong economic growth, be it US, China, the EU zone. The manufacturing PMI, anything that's above 50 shows that the manufacturing industry is in the expansionary phase. And you could see from the lows of the March last year onwards, all three region has actually shown very strong manufacturing activities, and hence indication of strong economic growth. And having said that, right now, as most of the international governments and Fed is actually looking, how do we go from easing and to right now to discuss how to exit. They do not want to shock the market. They do not want to pull out the support measure too quickly to cause a knee-jerk drop in the market and the situation right now. And having said that, they are faced with two issues: the record level high in terms of the balance sheet and the low interest rate environment. Show that the global central banks have really injected a large amount of liquidity since last year, causing and creating a ample liquidity environment right now globally. So with more effective as how we learn COVID-19, how it spreads, and how to be learn to live with it, with effective pandemic control, the right now the economic recovery facing a price pressure, many central banks are considering to exit this stimulation right now. This actually provide one room for them to actually reintroduce that should things touch wood take for the worst, and give them some room to maneuver for the next outbreak or next new form of COVID-19. And third, they want to actually do not want to build the bubble up too big as well. And when that bursts, they have no more ammunition to actually support the global economy. So I mean, like central banks actually ramped up massive asset purchases since then. You could see that it spiked up tremendously from last year itself. You could see the Fed buying a lot, ECB and BOJ, putting up a lot of debt in their asset purchases since last year as well. So but we think that the central bank policy rates could even be holding on even longer for both the Fed and BOJ and ECB as well. The next question is actually, when do we go on to taper? When would the central banks going to taper? It's up to two indicators, two data. That's actually up to the employment figures and of course the inflation figures as well. So market, are always looking at the Fed's monetary policy change, which has been the vein of global asset prices right now. And Jackson Hole, the Fed annual central bank meeting at the end of August is actually a key event you should actually take a look at, and we will be actually looking at the signs and clues from this event. So when will the question back to the question, when will the Fed begin to taper and turn to tightening? And CSOP, we believe that the full employment and sustainable inflation would be the necessary prerequisite for tapering. And it's expected not to kick off their tapering until the end of this year. So this is actually the timeline we're talking about. Right now, we're looking at Jackson Hole in August as well. And then we definitely have to look at the September FOMC meeting. Right now, the key is actually December's FOMC meeting this year. Likely, would there be a tapering announcement? And in January next year, that's where the tapering begins. And by then, what we look at is actually by the end of September, the net purchases would be zero. That's where hopefully the economy is stable by itself and strong to support itself. And we're looking at December next year for a first rate hike, and balance sheet runoff in January 2024, 2024 or later going forward. So employment, on the employment front, what do we see on any key numbers that we should look at? The US labor markets recover rapidly due to the stimulus package. However, it's still very fragile. The unemployment rate is actually far from the pre-pandemic level. If you were to look at the red line on the left, it's actually during the pre-pandemic. Unemployment situation actually is below 3%. We were getting, in terms of the non-farm payroll, we're actually seeing an increase in terms of new jobs creation, and people are getting more and more employed. However, the knee-jerk reaction after the chart on the right of the red line is that with the pandemic, we could see there's a huge drop in terms of employment numbers, employment jobs, and actually a huge spike in terms of unemployment, as high as about 15% of the US population. So having said that, right now, unemployment is due to also the labor shortage, which is actually the main problem for US right now. And with the expiration of the extra unemployment benefits, which ended just in June this year, for 21 states, which account for 27% of US labor forces, will have to return back to the labor force. And in September this year, there will be a full expiration of these unemployment benefits for all 50 states. And we believe that going forward, without additional unemployment benefits, most of the US citizens has to return to the labor workforce back into working. And that would definitely solve the situation of the labor shortage going forward. So inflation, right? Next, besides employment, we definitely look into inflation. Policymakers expect the high inflation right now that we see to be transitory. The reason why it's transitory because of the low base, the base effect that caused in the drop in the price, or so-called the low base formed in the spring of 2020 last year. And second is actually the huge stimulus measure, like extra unemployment benefits and millions and billions of dollars of stimulus check. These are the 2 points that would actually support the view that this high inflation is actually transitory, right? So after the unemployment benefits mature in September, we will see we have to see whether it's a substantial inflation on the average inflation targeting that the Fed put up, and we probably have to put up more weight towards the upward spiral in terms of price and wage relationship, right? So we believe this is actually what's going to happen after. The key is actually the inflation. What will happen? Is it substantial? Is it transitory or not? It's actually based on after the September expiration of the unemployment benefits. So last again, but least I want to revert back to the point that the Jackson Hole in August, end of August, is actually one of a very important event before any talks about tapering. And next is actually China outlook, right? China has actually enjoyed the largest post-COVID rebound, currently in a different recovery stage cycle from the rest of the world. However, China right now, after posting the strongest rebound from the COVID-19, they are experiencing right now an imbalanced recovery. So China is the first to recover from the COVID-19, but however, it's with its monetary and fiscal policy returning back to normal, give them a bit of room to breathe, to maneuver should any black swan event were to happen again. And right now stands in a very neutral stance right now. Standing in a very neutral stance right now in terms of supporting the market. It's like a protective parents with arms around a walking toddler who learns how to walk. This is what it's doing right now. They want to be a neutral stance to a protective stance, but they do not want the economy to be over reliant on to their their policies, supportive policies. So after a rapid growth, the economy right now is facing problems with uneven recovery. So imbalance number one, we have a very strong external demand. We see export figures coming in at 15.1 versus May, which is actually 11.1. So you could see external strong demand, but internally there's a very weak, a relatively weak internal demand. So China export grew much faster than expected in June with solid global demand led by most of the economy reopening. Is the internal retail consumption is still lower than the pre-pandemic level. Now the retail consumption or retail sales is very important because it takes up about 40% of China's GDP calculation. So that is actually something that the Chinese government needs to take a look at it. Definitely, they need to boost the domestic confidence to consume more, to boost up the retail sales in that sense. Second imbalance is actually a very strong upstream, but definitely a very relatively weak mid to downstream. So the general slowdown in the growth of the industrial added value in the mid to downstream companies, indicating that the impact of rising commodity price of the business operation right now. So this is actually what you could see that the growth rate for most of the compound growth rate for the major industries are actually facing a negative right now for 2019 to 2021. For China, inflation might stay modest. Just earlier in the panel, we see that right now, even though the PPI, the producer price index, has actually spiked up year on year, but with the bargaining power of the producers, they're not passing down the increase in commodity costs to the consumer. You could see there's a decoupling between consumers' price index versus the producer price index, at PPI, right? So we believe that PPI definitely will have likely to be a peak, definitely going to moderate in the coming months. year-on-year PPI actually came in and moderated at about 8.8% year-on-year in June, from a 9% year-on-year in May. So this is actually based on the large low base effect again from that's actually built upon in 2020. So with the slow recovery on demand side, we believe also right now that that the inflation will definitely be on the low side. So employment is still the key to see the fundamental improvement in terms of consumption. I'd like to skip through all this because I've left 5 more minutes. I just want to go through some of allocation views. So we remain upbeat in terms of Chinese government's bonds, valuation in the internet sectors, and under the pressure. Definitely the valuation of the internet sector is actually under pressure to create opportunities, and it has actually created opportunities for long-term allocations, right? Chinese governments were definitely overweight. Right now, with the yield spread between the 10-year Treasury and the US Treasury is about 1.7%. That actually puts Chinese 10-year Treasury in a very attractive position. In terms, we have a ETF that tracks the Chinese government bonds on SGX, and they have actually generated 6.5% and 3.5% in the SGD and USD class. This is due to the strength of the renminbi as well. So please take a look at this Chinese government bond ETF. On the AHS market, we are with the neutral policies and a tight credit control may not support the liquidity-led bull market for A shares, but we think the good profit growth will definitely boost bullish index for this. The Chinese index is definitely best earning performance for this year, generating a close to an 18% return. The CSI 500 index is actually a small cap index, generated about 11% year-to-date return as well. So fundamentally, this CSI 500 index is heavily weighted on cyclical consumption, hard tech, benefiting from the policies from the national policies as well. For Hong Kong market, we definitely overweight and believe overweight in the Hang Seng Tech. We could see that even though from the February high, the index has actually come down, we could see a huge inflows into the ETF that tracks the industry as well. So we believe long-term wise, Chinese tech companies will continue to deliver faster growth than the overall economy. Valuation right now remains under pressure, but definitely provides a better fair valuation for investors to consider to invest for a longer term horizon. Thematic cloud computing definitely pose a very good story to it. It's actually generated about 12% return. The renewable energy, which is the photovoltaic, actually generated a very, very beautiful returns of about 25.5%. That is definitely, we're definitely neutral on it because they have actually run up a lot. Healthcare, due to the pandemic, more focus onto the healthcare, aging Chinese population. We look at the healthcare industry right now, generating about 4% return. So these are some of the thematic series that investors can actually look at it as well. So I've actually reached the end of my webinar. If you have any questions, please do not hesitate to reach out to me via my email here. Yes.
All right, thanks, Adrian, for the wonderful sharing. I think, Adrian, your slides are super comprehensive, and I have to agree with you that the progress to recovery is not linear at all, because given the current, we're talking about regardless of whether intensifying of the trade war or even for COVID. Maybe even different variants after Delta, right? Who knows, right? So I think it is very insightful that you shared with us, your thoughts on at least, what's happening in the East, right? So, you mentioned a lot about the different indexes and the different themes where investors can look at for the upcoming trends, right? So I think for the benefit of the audience, I'd like to share some of these ETFs that tracks these indexes, right? For the A share market, there's actually the Chinese Index ETF. So the ticker code is 3147.HK, right? So for the CS, there's also another one called the CSI 500 Index ETF. Ticker code is 3000 3005.hk, right? So there's also another ETF that tracks the Hang Seng Tech index, right? So you mentioned earlier, Adrian. So this is called the CSOP Hang Seng Tech ETF. The ticker code is 3033.hk, right? And for the last but not least, I think the thematic ones are the really interesting ones, because I think a lot of investors who are looking for growth in the other sectors that are way beyond what investors can reach in terms of stocks, individual stocks at least, is actually the thematic ones, right? So there's this 3 ETFs that actually tracks the indexes, right? The very first one is actually Global Cloud Computing ETF 3194.hk. The second one, which would be the Photovoltaics Index ETF, it's 3134.hk. Last but not least, we tracks the healthcare index. It's called the CSOP Healthcare Index ETF 3174.hk. So, Adrian, did I get those ETFs ticker right? Awesome, man. All right. Okay. So we will end the session here. Thank you very much, Adrian, for your comprehensive sharing. So, if you like more reference to the ETFs, do take a look at the comments below as well, right? So we have an upcoming session, which is, the macro themes talk, which would be, presented by our next speaker, Thomas Bo. So I'll see you there. Adrian, thank you so much.
Thank you, sir.
Time.
Thank you.
All right. Awesome. See you in the next session. Bye.
Bye.